So next reading, multinational operations. This is one of my favorite readings at CFA Level 2. There is some section of the reading where we have to remember a few things, okay, which are also fairly logical. Once we remember that part, rest all is really high level of thinking. Okay, so you'd have to put in a lot of brains, and that will consume a lot of calories. You'll have to think in terms of different exchange rates, the impact on numerator of different ratios, denominator. So it's an interesting one. The whole idea of this reading is, let us say we have a parent company in US, and this parent company has two separate subsidiaries. The first subsidiary, let us say, is in India. The second subsidiary, let us say, is in Nepal. Now the Nepalese subsidiary has prepared its own financial statements. So it has balance sheet, it has income statement. Indian subsidiary has also prepared its balance sheet and income statement. The US parent company at the end of the year would want to consolidate financial statement of all these subsidiaries together. Now assuming that this Nepalese subsidiary is a dependent subsidiary, that means it does not have a lot of rights in terms of taking its own decisions, whereas the Indian subsidiary is a independent subsidiary. And these are the financial statements which are made in Indian rupees, and these are made in Nepalese rupee. How do we consolidate this balance sheet with the balance sheet of the parent company? How do we consolidate the Nepalese company's balance sheet into the parent company? How do we also consolidate the income statement? What exchange rates do we use when we want to convert? Do we use the exchange rate at the date on which transaction happened, or do we use the exchange rate which existed on the date of balance sheet conversion, or do we use an average exchange rate, or do we use different rate for different items? This is the reading is about. Are you fine here? So there would be three type of currencies we would be encountering. The first, and this is something you would want to write: local currency, functional currency, and the presentation, also called as reporting currency. Now throughout this reading I would be using one example of let us say Unilever. Okay. The Indian subsidiary of Unilever is Hindustan Unilever. So Hindustan Unilever is the Indian wing, and let us say, I'm assuming, I don't know this, but assuming that they have a small subsidiary in Nepal. Okay, so this is Nepal Unilever. Now what is the meaning of local currency? Local currency is the currency where your subsidiary is located. So for this Nepalese subsidiary, the local currency would be Nepalese rupee. Functional currency is the currency in which of the primary economic environment, meaning of which is the currency in which the subsidiary is doing business. Now it is quite possible that the Nepalese subsidiary is doing entire business in Indian rupee, or it is doing entire business in the local, which is the Nepalese currency. So assuming this subsidiary is doing entire business in the Indian rupee, functional currency in this case would be Indian rupees. If it was a case that this subsidiary was doing business in Nepalese currency, then the functional currency would have been Nepalese rupee. Are we fine? And the presentation currency is the currency with which we have to report the financial statement. So we would assume that that currency in this case would be euros. Are we fine with this? Yes? No? Do you want to ask anything, Shubham? Okay. So then moving further, let's read through the theory part. Local currency, the currency of the country to which it refers. Functional currency, see this part carefully. Determined by management is the currency of primary economic environment in which the entity operates. The functional currency is usually the currency in which entity generates and expends cash. It can be the local currency or it can be some other currency. For in our example, in case of the Nepalese subsidiary, functional currency was Indian rupee. And the presentation currency is in which the entity, that means the parent company, prepares its financial statements. Are we fine here? So now there are two possibilities. Now let us create a hypothetical scenario that we have an Indian subsidiary, okay, of let us say some technological company in US. Okay, so this is a US parent. Now it is quite possible that this Indian subsidiary is doing entire business in US dollars, correct? Or it is quite possible that this Indian subsidiary is doing entire business in Indian rupee. So what method do we want to use when we want to convert the financial statements? That would depend on how is your subsidiary located in terms of how much bandwidth does it have in terms of taking its own decision. Is it operating independently, or whether the decisions of the subsidiary is dependent on the parent. Is it fine? So now look at this carefully. If we want to convert the financial statements from the local currency to functional currency, okay, so again going back to the same example, if this is the Nepalese rupee and in our example functional currency was INR, so conversion from Nepalese rupee to INR, the method that we would be using is called as a temporal method. But from INR, when we want to eventually convert to euros, the method that we would be using is called the current method. Okay, so just quickly make this flow chart. Now see, how do I think of this? When I want to convert from the Nepalese rupee to Indian rupee, it's a temporary conversion because the eventual conversion has to be in US dollar. So since it is a temporary conversion, we would be using temporal method, or we would be calling this process as remeasurement. But from Indian rupee, when we want to eventually convert to euros, this is in a way a proper conversion, or we would be calling this as translation or the current method. Okay, so let's do a few examples. Let us say we have a American parent. They have a subsidiary in China, and the entire business of the subsidiary is done in Chinese currency itself. So from Chinese currency to US dollar, which method will we use? Translation, which would be the current method of accounting. But assuming that this Chinese subsidiary does not do entire business in Chinese currency, let us say they do entire business, now this is too much of exaggeration, but let's say in Russian rubles. Okay, so they do business in Russian currency. So from Russian rubles to Chinese currency, this would be using temporal, and then from Chinese currency again to the presentation currency, it has to be the current method. Are we fine with this? Okay. Now next LOS, heading in your notes would be foreign currency revenue transaction. Foreign currency revenue transaction. Now for this particular LOS, don't drop the idea of subsidiary. Just think of maybe let us say a US company. This US company has made sales to an Indian company. Okay. Now the sales was made on, let us say, 25th of December. The sales amount was $1,000 and the exchange rate on 25th of December was rupees 50 for a dollar. This sales was made on credit. On 31st December, the payment was not yet made, but the exchange rate had become rupees 60 for a dollar. The payment was made eventually on 15th of January when the exchange rate had become rupees 55 for a dollar. We are going to close our financial statements on 31st of December. What is the amount of sales this US company, in fact I shouldn't write this in US dollar, let me call this as 100,000 Indian rupees. What is the amount of sales this US company should recognize on 25th of December? $2,000. That means to recognize revenue, the exchange rate that we will use would be the exchange rate of the date of transaction, which would be 100,000 divided by 50. It would be USD 2,000. But on 31st of December, the exchange rate has changed. Should we account for the changing exchange rate on 31st of December? Yes or no? No? So on 31st of December, you wouldn't change your revenue figures because that was anyways recognized. But on the same day, you had accounts receivable of 2,000. But on this particular day, your accounts receivable with the current exchange rate, because your receivable is 100,000 Indian rupees. So 100,000 Indian rupees, current rate being 60, your accounts receivable now has become 100,000 divided by 60, that would be 1666. That means on this day, we will have to recognize a foreign currency translation loss, which would be of 333. Is it fine? But eventually when the transaction is settled, the amount that we would recognize is 100,000 divided by 55, which would be 1818. So the difference of these two amounts, how much is that? That's 152. USD 152 would be the eventual gain, and this would be again recognized in the income statement. Foreign currency translation loss and benefit both, and this is also recognized in income statement. Is it clear? Any doubts you want to ask here? Yes, you can think of this as trading security. So on the date of balance sheet, whatever is the exchange rate, you would resettle your current assets and liability, and then you would recognize profit accordingly. Fine. So write down the example. We'll move on. Should we go ahead? How did we get that loss? Foreign currency translation loss. No, it would go into income statement. What you learned at level 1, which I am sure some of you remember, that is something different. That will come very soon. Should we go ahead? Okay. So what do we know now? We know what is the presentation currency, we know the functional currency, we know the local currency. We also know that if we have made sales, what impact changing exchange rates can have. So in terms of amount of revenue, it would be determined based on the exchange rate on the date of sale. However, on the balance sheet reset date, we would again have a profit or loss depending on how exchange rates have moved. Now we would start looking at the two methods, current rate and temporal method. Let us start with current rate now. If they are giving credit, absolutely. Yes, otherwise there is no exposure to forex and there is no gain or loss. So let us say we have a subsidiary's balance sheet here. Let's say this subsidiary is in Indian rupee. We have a subsidiary's income statement. Again, it is in Indian rupee. We have a parent company which would want to prepare its financial statement using US dollar. If it is decided that the method that we would be using is the current method, And can I say that current method would be used for those subsidiaries which are relatively independent in their operations? Yes, because they are using their local currency as their functional currency. So all the balance sheet assets would be transferred to the parent company's balance sheet at the current rate. Current rate means the rate that existed on the date of balance sheet. Okay, so let's say 31st December 2013, 14, 15. All the liabilities, outsiders liabilities, would again be transferred at the current rate. However, the common stock and dividend, these two items would be transferred at historical rate. So these amounts would come in here. The entire amount of sales and other income would be transferred at average rate. All the expenses would also be transferred at average rate. So can I say the profit that subsidiary will have, this profit would also be converted at average rate? Do you agree with this? And this profit will eventually be transferred to reserves. And can I say that these reserves for this particular year would be at average? But last year the reserves must have been calculated using last year average, isn't it? So this reserves are on an average calculated at average of the previous average rates. Making sense? That means what was the average of the last year, that is also added here, but average of a year before that, that would also be added here. So now what is going to happen is, so these reserves that we have at average rates, or let me call this as average of all the average rates, and the first average is a weighted average because the amount of profit would be different. So balance sheet is not going to tally. So we would have one item here which would be a balancing figure, and that amount would be called as CTA, Cumulative Translation Adjustment. So it's a plug figure so that your balance sheet tallies. Do you want me to repeat this process again? Don't write, I'll make you write. Just try to understand this. Let's do it together. Income statement, the income side we will convert at average, expense side will convert at average, and then of course, which automatically means incremental reserve this year goes at average rate. The whole of the assets we transfer at current rate. All the outsiders liability we transfer at current rate. Common stock, dividend, these items we transfer at historical, which means your balance sheet would not tally. So we make a plug figure adjustment on the reserve, which is a part of equity, and that plug figure is called as Cumulative Translation Adjustment, CTA. Are we fine here? So what I want you to write down now is this. Okay, take your time, write down carefully, and make sure you mention this 1 and 2. Later on I'll explain what that means. This. So this part we are fine with. The entire asset comes at current. Most of the outsiders liability would come at current. Common stock historical. Historical means the date on which we had issued common stock. Dividend paid, the date on which we had paid it. Reserves, it accumulates average rate of each of the year, the rate at which it got accumulated. CTA is the balancing figure, so the balance sheet tally. Can you tell me why equity as a whole has to be at current rate? Yes, because if you see the balance sheet structure, entire asset side is current. So logically entire liability has to be at current. Outsiders liability anyways is at current. So that CTA would be calculated in such a way that entire equity section also would come at a current rate. Is it fine? Let's look at the next method now, which is the temporal method. Now, to truly appreciate the temporal method, we first need to understand two new terms, which is monetary asset oblique liability and non-monetary asset oblique liability. The meaning of monetary asset is that asset which is fixed in amount and it would not change, which means the value in your books and the value in the market would be always same. Whereas the non-monetary assets are those assets which might indicate a different value on the balance sheet and different real life value in the markets. Okay, so let me build a hypothetical balance sheet here. Let us say we have assets like this: land, building, plant and machinery, accounts receivable, cash, inventory. We have equity section here. In terms of liability, we have accounts payable, we have bank loan, and let us say we have a pension liability. Okay, what we have done in the previous reading, a PBO. Now, in fact, let me cut down on this for the timing. We have accounts payable and bank loan. Is the value of land fixed in terms of amount that we will receive? So this land is reflected at 200 on my balance sheet. So does it mean that irrespective of what happens in the market, I have to receive 200? No. So since it is not the case, this would be considered as a non-monetary asset. How about building? If this building is 300, this is again a non-monetary asset. Same logic for plant and machinery. So this is again non-monetary. Let's say we have accounts receivable of 150. Is this monetary? Yes. Because irrespective of what happens in the market, the amount we would receive is 150, and therefore this is a monetary asset. How about cash? Monetary again. So this is monetary. How about inventory? Monetary or non-monetary? So inventory in my books is 200, but maybe in the market it is worth 1000 or 20, isn't it? So the value in my books and the value on the market could be different. That means inventory is a non-monetary asset. Are we fine here? How about bank loan? Monetary? Yes, because irrespective of whatever happens in the market, the amount that I have to pay is always 500. So this is monetary. Accounts payable? Monetary again. Okay, which means most of the liabilities are going to be the monetary liabilities, and typically these items, accounts receivable, cash, these are going to be the monetary assets, and most of the other assets are going to be the non-monetary assets. Are we fine with this? Now we can't say fixed assets because inventory is also a non-monetary asset. The way I used to think of them is that those assets which would be affected negatively by really high inflation are monetary assets. Okay, think of it this way: if the inflation is really high in the market, my accounts receivable are worthless, isn't it? Same is true with my cash. But if the inflation is high, my land value will keep on increasing, building will also keep on increasing, so I am in a way protected. In the same fashion, if inflation is very high, I will have a big benefit on both of these items, because in real terms I have to pay less. So those values on the balance sheet which are affected significantly by the inflation number would be monetary assets and liability. Rest all would be non-monetary assets and liability. Are we fine here? So this part you can write down. What do you think? Yes, because it would be non-monetary, because the market value of that investment would adjust automatically to inflation numbers. It's not fixed. The value in my books and the market value could be different. Are we done? PBO would be a non-monetary liability. Yes, because the based on market expectation, the value would keep on changing in the market. It's not fixed in amount, so it is a non-monetary item. Yes, are we done? Okay. Now, example of a non-monetary liability could be PBO. Okay, again the intuition is that the value in my books and the value of liability that I might actually have to pay could be completely different amounts. Are we fine? Okay. Now, how do we do accounting in temporal method? Your monetary assets and liabilities, don't write. Okay, I'll make you write later on. Monetary assets and liabilities, these would be shown at the current rate. That means the rate on the date of balance sheet. But non-monetary assets and liabilities, these would be shown at historical rate. Most of the income related items would be shown at historical rate. Most of the average rate. Most of the expenses would be shown at average rate except COGS and depreciation amortization, which would be shown at historical rate. Can you guess why? Because inventory and fixed assets are shown at historical rate. To maintain parity, these expenses would be shown at historical rate, which means that your balance sheet, your income statement will have a mixed rate. Certain components on the income statement would have average, certain components of income statement would have historical, so profit becomes historical rate. On the balance sheet, certain assets will be shown at historical, certain assets would be shown at current. So again your balance sheet will not tally. But in this method, the difference of that amount by which balance sheet is not tallying, we route it through income statement, which means profit and loss in case of temporal method would be shown in the income statement, and then it would be brought back again to the balance sheet, and then financial statements would be tallied. Are we fine here? So the way you want to write this down is this. Monetary assets and liabilities we've already written. Most of the debt payables are monetary liability, and cash and receivables typically are monetary assets. This thing will keep on hold for a time. Let's see if we can recall. Monetary asset and liability temporal method. No, Anutej, temporal method. Current, Nitin. Yes, it would be current. But in case of current method, it would be current again. Now, non-monetary asset and liability, Nitin. Historical, are you sure? Current method. Current. Common stock and dividend, temporal. And current method, historical. Equity as a whole, temporal method. It won't be average. Average rate, typically nomenclature is used. Average rate during the year, which we use on the income statement. So equity as a whole would be at a mixed rate, because certain items are coming in at income statement, certain items historical, certain average, certain current rate. How about equity in current? Current. Revenue in temporal? In current. COGS in temporal? Historical. And COGS in current. Depreciation temporal. Okay. Net income temporal. In temporal, certain items are being recorded at average rate, but certain items are being recorded at historical rate. Therefore, your net income would be mixed. But this is not the same rate as equity in temporal. Okay, though it is mixed, it is not same mixed as the rate at which we had equity. These would be different rate. In case of current, it would be average. Now these 2 points we will keep on hold. Okay. In fact, now let's start discussing about them. Exposure. Let us say I have a subsidiary. I am using consolidation process and I am using the current method. Now, do you appreciate the fact that when you invest into a foreign currency, so let's say a US company in buying Indian rupee bond, then from that US company's perspective, they've made investment into two separate assets. One is the bond in India and second is the Indian rupee. That means if the Indian rupee appreciates, their value of investment will increase or decrease, vice versa. So in the same fashion, when I have a subsidiary in the foreign country, I have two investments. One is the asset of that subsidiary. Second is the currency of that subsidiary. So if the value of currency appreciates, value of my assets will increase. If value of currency depreciates, value of my asset will decrease. So now I'm using current method. Should I wish that my subsidiary's currency appreciates, or would I want it to depreciate? Appreciate. As against temporal, as against current, if I'm using temporal method, do I want that currency to appreciate or depreciate? Or we cannot say. We cannot say. That depends on, the answer depends on how much exposure do I have to the current exchange rate. Okay, for example, now in case of current method, the entire of my balance sheet and liability is shown at the current rate, and these are my assets, these are my liabilities. Can I also safely assume that for most of the normal organization, value of these assets would be higher than outsider liabilities? That means that net asset would be a positive value, correct? That means my assets are more than my liability, and therefore if the subsidiary's exchange rate appreciates, I will have a positive benefit. But if the currency depreciates, then I will have a loss because my assets are more than my liabilities. But think of temporal method. Your monetary assets are typically cash and accounts receivable, but your monetary liabilities will have short-term loan, it will have long-term loan, it will have accounts payable. So in most of the organization, the value of monetary liabilities would be higher than monetary assets. That means they will have net monetary asset as the exposure, and typically net monetary asset would be a negative value, which means my liabilities at current rate are higher than the assets, and therefore I would want that foreign currency to depreciate. Are we fine here? So what I want you to remember in this case is what is my exposure to current exchange rate. In case of current method, my exposure is net asset, and that is mostly a positive value. But in case of temporal, my exposure is the net monetary asset, which is mostly a negative value. Are we fine? Okay. So then write down this part. Okay, so let's move on. Tell me, what is the exposure under temporal? Net monetary assets. Under current, it is net asset. And exchange rate gain or loss, in case of temporal, we put that in income statement or balance sheet? Income statement. But in case of current method, we put that in CTA, which is a balance sheet item. Fine.